morning, everybody. How's everyone doing? Today is, of course, Tuesday, December 13th. Today is the day. Today is the day where we will get CPI inflation data month over month, year over year in the core. And this should tell us a lot about what markets may start to do here ahead of the FOMC decision and the Jerome Powell conference. However, I would just encourage you to keep a very open mind about outcomes from this and outcomes from this that are possibly different and, in extremes. So CPI may move the market higher big time. Jerome Powell may move the market lower big time. Maybe CPI moves the market down big time, and Jerome Powell has the opposite effect and moves the market higher big time, right? We don't know. We just don't know at this point in time. It seems like not every, but at least in this most recent cycle of the tightening, the Fed cycle from tightening, loosening, monetary policy cycle, everything's very, very important this time around. On the way higher, everything's all fine and dandy. Fed's keeping rates at zero. CPI is not really a big deal until it is, right? That was 2020. That was 2021. 2022 has been different, obviously. And our economic data has severely impacted the markets, right? So in terms of recent years, we're getting a clear shift in tone, and we need to be aware of these things, and that's no sound. Is everybody? I see one comment for no sound. Do we have sound? There should be sound. Check your video player. Anyways, I'm going to continue along unless I see a ton of things that say no sound. So CPI, let's talk about expectations. All right, live better. Please check your video player. I know you probably can't hear me if you're having issues in the first place, but it seems that the sound is fine. Anyways, back to CPI. Let's talk about expectations, right? So the month over month is fairly important because it shows us what the possible trend in the year over year will continue to be in the future. So we don't want to see it aggressively higher, but do remember that a 0.2, a 0.3, that's kind of an acceptable place for the market to be, right? That's an acceptable place for the market to be. If I just close this up here and we take a look at this graph, I mean, even before inflation became an issue, which was this, of course, notice that 0.3 is all right. It's not the end of the world, right? If we just look back through history, there's a couple reads over here, here. I mean, it's a little higher than what we'd like. I think comfortable for the market is 0.2. If you annualize a 0.2, of course, that brings you to 2.4% year over year inflation, right? So that's very close to the Fed's target rate. So a 0.2, a 0.3 is not the end of the world for the market. All right, it's just not the end of the world for the market. It's not great, but it's not fantastic, okay? Ideally, this is, again, between 0.1 and 0.2. This is the preferred range for CPI. When you print a flat read, of course, that's a sign of almost, deflation. So anyways, the 0.3 doesn't really have me all that concerned. What would be very concerning is if we come in higher than the previous and we print something like a 0.5, 6, or 0.7. Something up there is bearish for the market, of course, because what that's telling us is inflation didn't really become under control. That's an above average read. If we do something like this, these instances are not great for the market, and you can see the result of repeated back-to-back month-over-month extremes. Obviously, that put us in the situation of where we're at now. So anyways, the 0.3 strikes me as okay, but we have to hit that or come in slightly underneath. 0.4, starting to get uncomfortably high. All right, year over year, this is what kind of matters. This is what the Fed is watching like a hawk to determine whether or not inflation is continuing to trend lower versus higher. So I would say that, and again, I'm a nobody here. I'm just a guy on YouTube. I don't know anything about anything. I would say even if we miss the forecast by, I don't know, let's say 0.1, if we get a 7.4 here after expectation 7.3, it's still trending lower from a 7.7. So let's bring up this graph real briefly and just see what's going on with this one, right? So basically the idea here is that we want to continue to see inflation reads that are lower than previous. So the worst thing in the world would obviously be a higher read than 7.7. So anything north of 7.7, if we get something greater, market probably moves big time to the downside. If we get, let's do that. If we get something that's on par with the forecast, 7.3, I say that the market probably likes that. So let's go neutral, equal to neutral at 7.3 plus or minus. Let's go plus or minus 1 or zero point 0.1, that would be. I would say that the market's probably okay or probably rallies slightly. Then, of course, a big beat of the number, let's say 7.1 and lower, right? Market probably rallies. So this is kind of what I think about as the most important factor for the open here in the next, again, we're getting those numbers in about 7 minutes. 7 minutes, we'll find out what the numbers actually are. This is not 7%. That's in 7 minutes. We'll figure out what these readings are. So that's where my brain's at in terms of thinking about how inflation is going to be received by the market. I could be totally wrong. Could be totally wrong. That's why we're covering it live here on stream. That way we're all on the same page and we can start the day on the right foot. Okay? So this is really what you want to watch. To me, it would seem that the Fed probably most cares about at this point the year-over-year trend of inflation continuing in the downward direction. All right, so that's what I've got for you there. Core CPI, 0.3. If we take a look at the core, remember that an acceptable read is anywhere between 0.2 and 0.3, right? Somewhere right up here. So as long as that this is kind of in bounds, so to speak, with that, steps in the right direction. Again, this is what causes inflation year over year to get out of hand. This needs to continue to print 0.3s or lower. If this is high, if this is 0.5, obviously not great. You know, we're just on track to continue to do what we've been doing through here. So we want to see this continue to print reasonable reads like what we see through history in here, here, and here. 0.1 through 0.3. That's where it's got to be. All right. So that is your CPI breakdown from me, at least. We'll see what the market has to say about it. Of course, Wednesday, tomorrow at 2 o'clock, we will get the FOMC statement, the Fed funds rate, and the press conference from Jerome Powell at 2:30. That is very noteworthy. That's where he will be making comments in regard directly to the numbers that came out over here. He'll probably say something about jobs, and he'll probably say something about recessionary fears and the quote-unquote soft landing and how likely it is that we can still achieve something like that. I imagine he says we remain committed to our dual mandate, 2% inflation and maximum employment. And he just, says the whole ring around the rosy. It's all about reading in between the lines and figuring out whether or not he likes the data he's seeing up here or he does not like the data that he's seeing. All right. That's the main takeaway. Again, it's just a volatility event. We are not positioning early for this. We're letting the market react, and then we are reacting to the market's reaction to the FOMC. We'll keep you posted. Try to put out a video maybe tonight breaking down how we settle out the price action from today, and then we'll do the same. Here's today. Then we'll do the same thing on Wednesday as we typically do, the midweek market update, which will be a recap of the FOMC. So that's what I've got on store for you today. Let's do something like this. So we can see over here a 15-minute chart of the ES. So just as we're waiting, again, it's in about 4 minutes. We'll get those numbers. Let's peruse through a couple of stock-specific headlines. No thanks, Kramer. We're not going to join your club. In the meantime, what do we see for stock-specific stuff? SBF has been arrested, finally. Okay, took him long enough, right? Big criminal, I don't know if it's criminal misconduct. I don't know what the exact term is, right? But criminal negligence, I don't know what it is in terms of how he handled his folks' money there. But regardless, arrested. All right, let's see what comes of that. Let's see what else. Chip tensions rising. So watch your chip stocks, right? You're watching NVIDIA. You're watching AMD. There's a precursor reaction. Wow, look at that. Very interesting. We're 3 minutes early. We're 3 minutes early to the CPI coming out, and there was just a big push in the upward direction. Does that mean someone knows something? Is someone trying to exit and grab liquidity up here for a short? I don't know. But we are still 3 minutes early from the numbers. That, to me, seems like a slip-up. Someone knows something. You guys can let me know in the chat if you've got a faster news flow or squawk box than I do. Let me know in the chat what that was all about, but that was weird. All right, so still 2.5 minutes now to go until the official numbers come out, but we will see. Back to what I was saying, you're going to want to watch your chip stocks just based on this headline right here. Okay, so expect some volatility with the tensions between China and the U.S. there for AMD, NVIDIA, Taiwan Semiconductor, Applied Materials, right, is involved in the materials for the chips, so things of that nature. United Airlines buys at least 100 Boeing Dreamliners to replace the aging jets, so bullish for Boeing, big order there. A 10% pop in the S&P on Tuesday. What JP Morgan's trading desk's note on CPI really says. Interesting. So is JP Morgan the one doing this? Who knows? But I will say that this is not just an accident. This is not just a slip up. Look at the volume increase down below. Someone intentionally knew what they were doing. It's not like we had 3 contracts go through and the market did something like this. This is reasonable. This is sizable. Okay, so someone knew something. Still, about a minute and a half to go until the official numbers come out. I think most of these headlines will just be about inflation. To be quite frank with you, consumer inflation expectations are continuing to cool, but still high. Futures rise slightly as investors await key inflation report. What else? We're looking for anything inflation related, maybe. Oracle was earnings. Boeing had the jet order. Not sure about mRNA there. What else? In the last minute, we'll just go directly back to the other screen and see what we've got. Upgrade to Pfizer, right? According to Goldman Sachs, saying that we can outperform even as the demand for diminishes. What else? Federal Reserve is about to hike interest rates again. Yeah, of course we know that. Thank you very much. 50 basis points. What else? Anything? Citi says Carvana could do well in a more normalized environment. Yeah, I don't know about that. And that's it. Everything else is all about inflation headlines. So what we'll do is we've got about 30 seconds to go until the release comes out here. We're going to do this with our chart so we can just kind of see again for anyone just tuning in who's not familiar with the stream. This over here on the right-hand side is the ES futures on a 15-minute time frame chart. And in about 15 seconds, we're going to get the official CPI release numbers from whoever calculates them, the big boys in the sky. Guys in the sky. Let's see. What do we have? There's the forecast, and here we go. Volatility. Let it commence. Big move in the upward direction to start. Continuing to push higher. Looks like maybe there was a beat on inflation. Looks like there was potentially a beat on inflation. All right. So usually Forex Factory takes a minute to get the numbers in. So I'm just going to let this simmer out for maybe another 15 seconds. That'll be a full 30 seconds for Forex Factory to get the numbers. And then I'll give it the refresh so I'm not yelling at it like I always do, saying, come on, give me the numbers. Give me the numbers. I'm sure someone else will say in the chat, oh, this is what it is. So anyways, it's been 30 seconds. Let's give this a refresh, and we'll see what's going on. Click the green button. Show us the numbers. Look at that. Beats across the board. This is exactly what the market did want to see. We've got that 0.1. Remember that this is a very comfortable place for the month over month. We've got a big beat on the year over year. Remember that this was the upper edge of what we just considered was a rally. We gave it plus or minus 1 point, or 0.1 point, right? We gave it plus or minus 0.1 from the forecast to be neutral. And what we literally just said, you could go rewind the stream, is that a 7.1 or lower, oops, that's greater than, or lower, would be bullish for the market, and that is what we have here. So that's that. The numbers are out. Everybody knows the deal, and they're better than expectations. The same thing with the core, right? Remember that the core, this is particularly important as well, wanted to come down, and it wanted to show us a number that was on par with, something that's comfortable for the market. This is what drives up your year over year to crazy, crazy readings like what we had, right? So market's content. Market likes what it sees. That is a good thing. Now, does this mean that we are just full margin long? Portfolio is all in, everything you got in the market? Absolutely not. Tomorrow at 2 o'clock, things can change in the blink of an eye. In the blink of an eye, Jerome Powell could come out and say, you know what? I think that these readings were okay, but obviously 7.1 is still very, very aggressive. We're trending in the right direction, but we still got to be aggressive with those rate hikes. This we wanted to see it underneath. Let's just pretend this, right? Again, totally theoretical scenario. We needed to see the number under 7%. We were looking for a 6.9, so we're actually going to give you the 75 basis point rate hike and really continue to put the hammer on inflation, right? Again, totally hypothetical situation. I'm not saying that that's going to be the case. Of course, we know that the priced in amount is a 50 basis point rate hike, and that's usually, what the market gets is what the market expects, or rather opposite. What the market expects is what the market gets. So, I just want you to be open. I want you to be open to a wide possibility of outcomes from now the 2 to 2:30 announcement on tomorrow's session from the the Fed and Jerome Powell specifically, and his comments on how the numbers are continuing to come in from his perspective, obviously, as the guy in the seat. All right? So that's the big deal. That's the market move. If you made money on it, congrats. I would say try not to make it a habit of gambling on things like this. If we take a look at something like liquidity through the move, so this is always just a good exercise, right? Let's look at liquidity through the move. It was so illiquid until where it's kind of settling out up here that we didn't even print on Trade-Evade. Let's see what we got. All right, so here's the reason why it's really difficult to trade these. Even if you have, let's say you were short up here. Let's say you were short and you were thinking that the market was going to move lower. Do you really think that your one contract lot was going to be the first in the queue when we filled 1, when we filled 5, when we filled 4, 3, 5, right? You're not first in line. You're not first in line. Your order gets jumped, and next thing you know, you're way underwater, okay? So the liquidity through the move, very, very sparse, very, very thin. The reason why it looks so large on a volume by time basis here is because it's all stacked in the blink of an eye, right? It's all stacked in the blink of an eye. But in reality, all the way up the move, very, very thin until we start finding some liquidity up here, and you can start to see things normalizing with, a couple hundred contracts, which is fairly normal for the pre-market, right? Towards the high, let's see, did we get a taper? A little bit of taper up here, 51 contracts at the high so far on the move. Not ultimately the end of the world, or end all be all, I should say, in the pre-market here to be looking at the contracts that printed at the high. Anyways, what does this mean for us going forward? We've certainly broken out of this balance area. We've moved through the thin structure here, and we're basically at the top of the range, if not higher from before. Excuse me. We are struggling to accept right around this area. You can see that's where the market in the pre-market, this orange line, is wiggling around. So let's just do what we do best, and we'll get on over to the ES price action real brief. Just wanted to point out, because we had Oracle as a headline, they reported earnings after the close yesterday. Nothing else really interesting is happening on this week's session other than Adobe possibly on Thursday from an earnings perspective. So we'll leave it at that for a look at the earnings. In terms of the charts, though, let's get on over here and let me bring up this a little bit. Come on, play nicely. Just trying to make this a little bit better. There we go. All right, so let's do it. 4-hour time frame chart. What's going on from the highest time frame that we look at? What is this move doing for our market, right? We were very concerned about the possibility on the 4-hour chart. This has been a main concern of us, of the channel, right, is that we had lows, higher lows, higher lows, higher lows, higher lows. This was an equal low from here to here. So this was starting to become like, okay, yeah, from here to here, we've got higher lows. It definitely looks possible that this is building out higher lows, higher lows, higher lows. But from here to here, as we just pointed out, equal low starts to become a little bit concerning and neutralizing for our trend, especially after a high and then coming back down into range, dead cat bounce, lower high here. So things on the 4-hour are still, I would say, kind of neutral. I know you might be like, dude, how could you say it's neutral? We're getting this big green move. Think about it like this. If these are equal lows, and this is kind of like a broadening formation, it's really not as bullish as it could be. It needs to find a higher low before we get bullish on the pattern, right? Otherwise, the rotations just get more and more extreme. And if we do attempt this base again, you could look for a breakdown off of that. So that's what I'd say about the 4-hour. Still kind of neutral from that perspective. And if you do something like this, I suppose today will tell us a lot on whether or not we accept above the prior pivot highs from here. Remember that we did have support one day for it here. We opened underneath, but rallied back above on this day here, right? So if we open above and stay above the top of these highs right here, that could also be interesting and meaningful for our market in the upward direction. All right, that's what I'm trying to say. So opening and staying up here puts into play possible breakouts. Remember, tomorrow, 2 p.m. could change everything. We could easily do something like this at 2 p.m. tomorrow from the Fed comments. So still, I don't think it's time to have extremely high conviction in this market. I think it's time to be open, as we've been pointing out, to a wide possibility of outcomes. So anyways, in terms of the 4-hour and what we have in front of us for today's session, I would say that, yes, it's a big step in the right direction for the buyers, getting up into this equal low area. It's all about, can we hold up outside of now, right here, the prior two highs, which offered one day of support. We rallied above here, and then it was all a breakdown from. So let's take a look at the hourly. Let's get a little bit more granular here and make sure we know what we're looking at. So why is 40-45, it's this 40-ish area important? It's because that's where the breakdown came from, right? If we look at this with our after hours off, let's go ahead and do that. Here we are. Notice that you get your regular trading hours high, your regular trading hours high, high, and then breakdown from here, right? Boom. So this is still an important zone. If you're going off of regular trading hours only, you're watching 40-37, 40-40. That's here. Adjusted down slightly from 40-45. Let's go 40-40 as our first kind of must-hold area if the market comes in even further. About, what would that be? 60, 70 points or so, right? If the market comes in 70 points from where it opens, that's your support, all right? If the market is above this, then, higher high on the table, that's probably the most bullish outcome for the market up here, okay? So hourly structure is telling us, at least on today's session, pullbacks could be buyable as long as they come into support and turn around at a reasonable place. Let's now go to a 15-minute, and we'll just throw on our extended hours again. So I think I can do that here. No, I can't. Into the settings, into the futures show. Good. All right. So 15-minute time frame chart. Let's keep it pretty objective here on the 15 and just look at what price is telling us or what it's trying to tell us it wants to do. So we're opening above both of the gray bars, which we just saw on the hourly as well as the 4-hour chart. So of course this is more bullish than bearish. However, is it wise to be chasing it big, new money longs up here? I don't know. I just don't know. We're already seeing a sizable pullback. I mean, keep in mind, we went 41.80. Now we're trading 41, let's just call it 20 for easy math. 41.20, sorry. Apologies. 41.20 to 80, right? 60 points. So we're trading 60 points off of the high. I mean, there's a lot of volatility here. That's kind of what I'm getting at. So I don't know that just long here is the case. I think pullback to here makes sense to watch for a long with tighter risk reward off of the level, right? So opening, pullback, partial gap fill, and a long off of here looks good. And then just complete collapse, lower high underneath. I would expect a retracement through the thin structure that we literally just pointed out from a volume by price perspective. Remember, it was really thin. We had 5s, we had 1s, we had a gap, we had a 4, 3s, 2s, really, really thin structure on the market profile that we just saw. So something that looks like this, then rejecting this prior, remember that this is overhead resistance from back there. If we get underneath that for a lower high, I think you could treat, some more of the gap fill as the reasonable trade and be short through this area with a stop somewhere over that lower high, right? So the two scenarios that I would kind of focus on for the most optimal trade in the morning session here would be, first is pull back to here. If it supports there, let's see if we can find a buying opportunity. So it could just be a simple hammer candle. It could be a intraday double bottom on a 5 or a 15-minute chart. It could be an inverted head and shoulders on a 5 or a 15-minute chart. It could be a number of things, but these three are the easiest to talk about, easiest to trade and identify. So something like that off of and around, let's just say that this is 40.90 as the lowest. Something around 40.90 is possibly interesting for a reversal on a pullback, right? Partial gap fill, buyers step up. Let's see if we can push it back higher off of that. If we get something underneath for a big lower high underneath 40.90 here, looking for a short entry either right at this lower high, if you can pick it off, if you can find the inverted hammer, if you can find the double top, if you can find the structure there, stop as close as possible, looking for either an entry based on a candle structure in there or underneath the equal low here, break of low of day, continues to close the gap in the downward direction, in which case we're starting to look at 40.40 as that next zone of importance. Okay, so 40.90 and 40.40 are your big levels for today's session that I would want to be aware of. Now, one thing that we always say, always say, whenever your gap is more than 20 points in the ES these days, it used to be 10. Can you imagine that? It used to be whenever your gap was more than 10 points. But these days it's doubled, all right? Because of the volatility, because of the situation with the market. When the gap is more than 20 points, could be up, could be down in the case of a gap down, right? But in this case for today, the gap is far larger than 20 points. It's almost 100 points. It's 110 points, 113 as we're talking right now. Let's just call this, roughly around 40-20, right? So 110-ish points. really, really large. Could the market very well just go sideways here and not do anything all that impressive? Absolutely. Absolutely. So whenever your gap is larger than 20 points, the market very may well not do anything impressive on the open, especially as we wait in limbo for a Fed announcement on tomorrow's session at 2 p.m. If the market just wants to stay sideways up here and say, hey, the numbers were good, they checked out, they were steps in the right direction, but we don't know what, Papa Powell is going to have to say about them. So let's just hold our breaths here. We're not going to make any assumptions higher. We're not going to make any assumptions lower. We're just going to hold it. Market very well could do that. So days like this are fairly difficult to trade when the gap is larger than 20 points. We still stick to the gap rules, which we'll go through in just a moment here, but they can be difficult to trade, which, as always, brings me to our infamous E word on the channel. Chat, tell me what the E word is in the channel. What do we have to manage on today's session? What is this E word that I always talk about on the streams? All right. It's not going to be an official poll, but I want you to actually type it into the chat. What is it? Right? What is it? Okay. I'm getting a couple of things. Someone says envelope. It is not envelope. It is expectations. It is expectations. Expectations. Absolutely. The chat. Ego, same thing. Right? So good on you. Headwing. Emotions. Emotions, expectations. I prefer to use the word expectations, right? So we need to manage our expectations on today's session. I think that the market could very well give us a very tricky hand to play up here on the massive gap, considering it's like 100 and, what did we just say, 110-ish points in the upward direction, right? So it could be a very difficult morning session to unpack. But regardless, let's walk through the 3 questions. We'll keep it objective, and we'll just make comments based on price, not what we think will happen, right? So question number 1, where are we opening in relationship to the prior day's range? Here's the high, here's the low. Big move in the upward direction, significant move outside of the prior day's range. I mean, there's no arguing. We're opening outside of the prior day's range. As we just talked about, it's about 110-point gap up, all right? That is bullish, right? Don't get me wrong. That is bullish. It's a big move in the upward direction, but as we know, there are some things that we would be skeptical of. So let's go to question number 2. Where are we opening in relationship to the overnight range? Here's the high. Here's the overnight low. Obviously, we're opening much closer to the lower edge of like the upper fourth, if you wanted to classify it as, I'd say thirds maybe. Actually, sorry, it's here. Yeah, lower edge of the upper third. We'll just call it that. We're opening in the upper third of the overnight range. After this big CPI move, we're opening in the upper third. So that, of course, is more bullish than bearish, but it's a good thing that we're opening there because now if we think about risk reward, if we're trying to trade for a gap close, which is what we know is the primary objective of opening on a gap, right? Then our risk reward at least makes better sense up here. As long as we're opening in that upper third, failed rallies that do not take out the overnight high, again, we'll talk about gap rules momentarily, at least give us better risk reward for a full downside gap, right? Now, that does not necessarily mean, let me be very, 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 very clear about this, just because the risk reward is favorable here on question number 2, does not mean that the probabilities, the percentage probability of this trade working out is higher. It just means that you have a better risk reward ratio, which is ultimately what we're shooting for at the end of the day in the market, right? So the risk reward ratio is better, but the probability of the trade working does not increase when we're up here. Maybe to some slight degree it increases because we're closer to the people who have poor trade location. And, anyone who's long from up here, as soon as we start moving lower, last in, first out, right? That's how we think of the participants up here. So maybe if we're closer to the top, we have more of that pressure on those folks who are last in to be exiting. So maybe there's a slight bump. I would say it's like maybe at best a 1% increase in your probabilities of the trade working better when we're opening in the upper third. But primarily, this is all about risk reward. So question number 2 is telling us, okay, the risk reward might be there, but let's still remember we've got to manage our expectations, right? So this is still paramount in the corner of the screen. And then question number 3 tells us, what's the overnight inventory position? Net long, net short. Well, if we extrapolate the settling price, same thing as saying the close from the prior day's session, 100% net long. 100% net long. All right. So what does this tell us? Well, if we're 100% net long, then if the inventory does correct, it would mean a downside move. So this also checks out as being, skeptical of just blindly buying this thing on the open. So what I've tried to do over looking at these three questions very objectively here for us in the pre-market is I want you to use your brain on the open. All right, I want you to think to yourself, if I just blindly buy this up here at these highs, am I entering with good risk reward? Do I have a reasonable, is there a reasonable expectation for the market to move higher here? Or would it make sense that we should probably be a little bit more cautious on a day where the gap is so large? Maybe we start to look for that rotation here, and the better long is off of a level that is acting as support. That way we've defined our risk on the downside. So if you try to long this, right, your stop goes here. Now you can maybe retarget the opening print from up here. Maybe that makes sense for a 3-to-1. So a little bit of patience. Instead of just smacking it short, expecting the full gap to close all in one shot, maybe you say, all right, I'll be patient. I'll wait for the lower high about midpoint of the gap right here. And now if I'm entering underneath the low of day, stop over that dead cat bounce, now I've got a risk reward that looks something like this. Again, we've got a 1 here and roughly a 3 here. So today is about managing your expectations on the open. These sessions are extremely difficult to trade. If you're someone who's not comfortable playing around in the morning volatility, and maybe you're a trader who's tuning in on the road and you're listening into the stream, and typically you put in some orders around the market open, you go to work or whatever, and then you check them at lunchtime or something like that. It's probably not that type of day to trade. I'm not saying that everybody's doing that, and there's no better or worse, or this is good as a strategy, this is bad as a strategy. It's all about what works for you, but you have to understand the context of the morning's open. So the context of this morning's open is that this, I would imagine, is a very difficult open to trade. All right, that's what I'm thinking about on this open. This will be difficult. It's probably going to make a lot of people frustrated. Everybody who thought the FOMC and the Fed, the CPI and inflation was going to send the market lower, if they didn't have a stop in from yesterday's late day rally, blowing up, right? Anyone who thought it was going to be long, feeling really happy. So you're getting parties who are at their wits' end, right? These folks are so frustrated and bent out of shape that the market rallied, and these folks are so euphoric that they probably can't see any reason for downside. So when it seems like the blinders are on from both sides, it might be a difficult morning to trade. So regardless, what am I going to do on the morning session? I've already sort of walked you through what my thoughts will be here. I know these ranges are extreme, right? If we open here, there's nothing to do until we fall 40 points to 4,100, right? And then from here, either watching for the bounce off of it or watching for the lower high underneath. That would be a preferred situation for me on this morning session. When and if we get here, remember that E word, right? If the market's already fallen 40 points to get to the inflection point, you probably don't want to have to target all the way to the prior high of day and ask the market for another 60 points to make this trade worth it. Can it happen? Can the market make this full rotation? Sure, the market can always do whatever it wants. But in terms of managing expectations and thinking about things reasonably, right? If you're looking for the short here and the market has already moved 40 points off of the open, maybe you should say, all right, is it reasonable that I might be able to get 20 points of downward action here? And if so, I need to put my stop loss somewhere that's like 5 points to 7 points, right? You've got to find a stop that's between 5 and 7 points if the market can then, under the volatility, under the velocity, so to speak, of the day, just 2 V words for you, the speed, the tempo of the day. If we get here and things are like, the market's actually looking a little bit tired, like I don't know how much further it can go from here, you've got to find a setup that looks like this. Otherwise, you just can't, the risk reward is not there for taking these trades. All right, so it's going to be a difficult morning. I would say that this area, again, is of paramount importance, 40.90 here up first. If the market does rally, of course, we're looking at the overnight high as the major gatekeeper, right? Overnight high, 41.80, 41.80. All right, if we get to the overnight high and we reject off of it, maybe there's a reason to go short up here, and the target would be the opening print. Again, can you find the risk-reward trade there that makes it make sense? There's nothing. I don't think that there's much to do here unless there's just an intraday setup that forms and you can find that tight risk trade. Otherwise, I think the bigger inflection points will be a retest of this or a retest of the overnight high. Playing around in the midpoint, I don't know. I don't see it. I don't see the high probability outcome as we're chopping around in the middle. Something that I do want to do, because we have not talked about upside targets in quite some time. Let's go to a 4-hour chart and just see what we're contending with off to the left. Like, doesn't make sense where we're coming in to find this rejection point. So if I do something like this, we're just shy of 4,200. If I do something like this, that kind of makes sense. All right, so let's go to an hourly, and yeah, this will do. And let's see where those levels are. All right, so up here, no, up here, right? Yeah, that's closer. All right, so what I would do is I would do something like this and say here is the next big thing to be watching at the highs. Let's edit that and extend it to the right. We want to go here. Let's just go way out in time. Beautiful, January 1st. All right, back to the 4-hour, back to our extended hours. Let's do this so we can just make a shortcut. And if the market moves over the overnight high, it will probably run into some resistance and some slowing down around 42.05 to 42.25. I know that's a 20-point range. I know it's real large, but we're dealing with lots of volatility right now. Okay? So to sum it up before we take the YouTube poll, because I'm actually very interested in seeing what the chat seems to think is going to be likely on this morning's session. Very, very interested in what you guys have to say. Where my head is at, I'm looking for not much to happen here in terms of offering a good setup. I'm watching for a pullback to that 40.90. And when and if we get here, that's 40.90, not 40.40, 40.90. Watching for primarily a bullish rotation off of it, right? So a bounce, partial gap fill, supporting at the prior structure highs. That would kind of confirm more of a bullish look in the market, or a lower high underneath to possibly come in and start filling the rest of the gap. Or I'm looking for an inflection point at the overnight high, which is 41.80. All right, 41.80. So that's where my head's at. This would be the objective if we push higher first, right? Looking for a rejection off of 41.80. All right, that's where my head's at. Let's go to the 15, and we'll see what the chat seems to think about as scenarios on today's session. I'll draw on a couple of scenarios. So for all you bulls out there thinking that the market's going to digest, maybe higher low pullback, and then just go back to the overnight high, or let's even say in a number one situation today, opening range, break, higher, and then higher after that. Let's see a number one in the chat if you are bullish to that degree. If you are a little bit more neutral on the day's session, so maybe a pullback here. Look at that, going yellow for neutral today, stepping it up. Maybe we do something like this, lack of trend. Maybe we close the gap all the way down here. It's a little bit lower, actually. Maybe we do something like this, but more of a pullback, filling some of the gap, most of the gap, and then sideways, nothing really all that impressive. Let's see a number two in the chat. And then I think I can do it, but I've got to go up here and I've got to use the cheat codes. We'll do that. If you're a bear on today's session, thinking that it's lower high, close the gap, lower high again, break into the prior day's range. And let's say for a number three on today's session, you're expecting a close underneath your prior high of day. All right, so 1, 2, and 3 across the board. I've got no fancy colors for you. What I should have done, darn it, what I should have done was use the green marker for bullish, but I've got no fancy color for you on the number 4 situation, the ostrich situation, where you've just got no clue what the market's going to do, all right? So regardless, I'm going to let that poll simmer in the chat for just a moment here, and in the meantime, I'm going to fire up the official YouTube poll. We'll type that in. We'll get it typed in here. So what do you think? We'll go bullish, Newt. We'll throw in a couple more options, 3 and 4, of course. 3 is going to be your bear, and 4 is going to be our ostrich. All right, official YouTube poll is out there in the world. I'm going to scroll up through the chat, see what we've got for questions, comments, concerns. I'm going to go all the way to the top, and I'm just going to blast through the green names to see who we've got here in the stream this morning. We've got INF. We've got the Sandman, Raz, John Cardozo, Doug K, Who else? Nick Farrell, Stevie J. We've got Davey. Who else? Siege. I'm probably missing some. The chat history doesn't go all the way to the top, so I apologize if I do miss you, but I am just focusing on some green names right now. Ty, Headwing, Crypto Commando, Stargazer, Kevin Weston, Sharath is in the building. Who else? Who else? I think that I see you, Steve V. That's not Stevie V, that's Steve VA. And then we're into some poll responses. So let's dive into the poll responses and see what's going on with that. So a lot of ones early on in the stream. Remember that what we typically see is that the chat works like this. Let's pretend that this is a list of all our responses, right? We're getting people responding, so on and so forth. Usually about this much of the chat is aggressive on a particular direction, and then this on the remainder is aggressive on a different direction. This is not one like over here one, and this is not two like over here two. I'm just saying the two segments of the chat responses are usually very divided. But so lots of ones and twos coming in early. Let's see if that changes as we move lower through the list. Lots of twos, and we don't really flip to threes. I'd say a lot of people are in the 2 and 1 camp. A lot of 2 and 1s, even as I get lower through the list. So very interesting. Seems that most folks are on the bull side of the market here, expecting that we are at least going to get some kind of higher low well above the prior high of day, even if the gap closes all the way. Most people are feeling fairly bullish, it would seem, from the chat. And right on time, we've got our 69mega.com. Our AI will help you find a perfect match. Yeah, let's get you out of here. We don't need your AI. We'll focus on like Tesla's AI maybe, or AI that helps improve our trading, but we don't need a matchmaker here. Anyways, run spam bots, get out of here. We got them. All right, this is the poll, right? Most people are in a category 1 or a category number 2. I would say that's fairly bullish for the market in terms of sentiment. Most people are feeling good up here. One thing, last note before I move to the NQ futures, the last note that I want to just end on, for the ES at least, please, if you're going to do anything this morning, manage your expectations. Don't think that you're going to get in here and the market's going to give you a big home run trade to the upside. Don't think that if the market does come into this area, it's going to give you a big home run trade on the pullback. Just because we've identified the level that keeps the market bullish, on a gap of this size, let me just reiterate this as the final note in the ES, right? On a gap of this size, 110 points, roughly. Even more than that now, 120 points, right? This is more than 5 times what we would typically classify as a reasonable gap to trade. All right, so it doesn't mean don't trade up here, but it means please be careful. Don't do anything silly, and don't hold on to a losing position if you can't afford the risk given the volatility up here. We're talking about massive ranges, people. Massive ranges. These are the types of things that will blow up an account if you don't have enough liquidity. Like I'm thinking about futures specifically because we're talking about ES. If you get in here and let's say you're trading the ES with, I don't know, a $5,000 account, which is something I would not recommend, by the way. But let's say you're trading the ES with a $5,000 account. All it takes is something that does this. If you're trying to put a stop over the overnight high, margin call, blown up, goodbye. Try again next year, right? So be careful. Be careful. Understand the volatility. Understand the ranges. It's a lot. All right? That's the ES. Let's take a look at the NQ. What's going on in the NQ? Higher time frame first, 4 hour. How is the structure looking on the 4 hour NQ? Very bullish, right? Very bullish on the fact that we are now back outside of the original balance area from here and also outside of and above this balance area from in here. All right? So very bullish from that perspective. We are opening around and near this area of prior resistance, and we've got a prior gap overhead to be thinking about as a primary target if the market moves higher first. Let's go for hourly chart. Let's go hourly chart. Yeah. JT started his ES with a 1K account. Well, I mean, kudos to you, man. Kudos to you. That means either you had extremely tight risk reward and you built it from there, or you just hit a home run trade out of the gates and you had that cushion. I would not recommend anybody trades the ES with anything less than, at this stage, I would say you probably want a $10,000 account at minimum to get involved in the ES. Anything less than that, look for the micros, MES, MNQ, right? You need the bullets in the chamber. You need the bullets in the chamber. It's tough. It's tough. Yeah, micros with 5K doable, 10K minimum. Yeah, exactly. All right. For anyone else asking about the futures rolling contracts, yes, please bump forward to the next expiration, which is the H23, right? We're on the H23. That's the March contract. No longer is the Z contract expiring this Friday, actually. No longer does the Z22 have more volume. So get off of the Z and move to the H, all right? NQ, continuing along with the analysis. Remember that we were looking at in prior videos, prior analysis, the fact that we had possibly lower highs, lower lows along the way. This has obviously changed with a big higher high over this set from here. It's got to be more bullish than bearish now. Granted, we still have the gap. We have gap rules in play. From an overall sentiment perspective, this is a big change in tone. No longer hanging out towards the bottom of this overall range. All right, let's take a look at the 15-minute chart, and we'll give a quick breakdown of our gap rules and the numbers here, and then we'll just continue to blast along. I'm going to echo all of the same sentiments that I was just discussing in our ES in terms of managing your expectations, in terms of recognizing that the gap here is extremely large. Remember that when it comes to the NQ, right, ES, we look at gaps that are 20 points or better as being tough. In the NQ, obviously there's a lot more range here, so we talk about gaps that are 100 points or more. Notice that the gap in the NQ is like what? We're talking about 11,834 to 12, excuse me, 12,295. So, I mean, just huge, 1,400 point gap, right? So just gigantic. Manage your expectations. Please don't be attached to outcomes up here, especially if you can't handle the risk in the NQ, which moves at an even faster pace than the ES, right? Be mindful of that up here at the highs. Now, for this one, we don't have that beautiful half gap pullback level like we just saw in the ES. So yes, gap rules are in play. We're opening very close to the overnight low. I would use this 12,225, excuse me, 12,250. All right, this as the zone. Remember that that's what we saw on the 4-hour time frame chart as the structure of prior resistance off to the left. After that, it's the gap overhead, that yellow bar. I don't know that I would be, bullishly reaching for that type of trade here. I think that the play in the NQ would be, all right, can we go sideways here and then possibly break down underneath that 12,250 that we were just discussing? All right, so if we break down underneath, that's kind of your bear entry for the gap close. You would want to see a failure at the overnight high, possibly lower through the opening print, finding maybe another lower high, even considering the ranges are so large on something like a 5 or a 15-minute chart, right? For a tight risk reward setup, and then your target is here, 1,200. Not only is it a round figure, 12K even, it's also prior resistance from the top of the range, right? So overall, the downside looks more attractive from a risk reward perspective here in the NQ, but again, let me be very clear that just because the risk reward looks better does not necessarily improve the probabilities of the trade working in the first place. The risk reward makes sense for downside, but the probabilities are not majorly skewed. Maybe, again, as we pointed out, about 1% skew, as the overnight players here feel more pain sooner if we start breaking down, right? So maybe there's a 1% skew in terms of probability and likelihood of trade working, but the risk reward is better. The probability is not necessarily dramatically improved, we'll say, for the sake of argument. So this would be a preferred outcome to break down underneath this to close and repair some of the gap underneath us. If the market goes sideways and stays above that 12,250, then guess what? There's no reason to be looking for shorts. If there's no lower high down there, there's no reason to be looking for shorts. If we're above the opening print, please do not be looking for shorts. If we have not failed to move back down under the overnight high after taking it out, there's no reason to be looking for shorts. Okay? If we put in an opening range and we break this to the upside, you can play it on the long side, but please remember what we just said about expectations. Again, I'm beating a dead horse, but it's very, very important for anyone tuning into the stream. I have no idea what your experience level is with the market. Usually, people who have traded a million CPIs, they don't tune into me. Maybe some do, but the folks who know exactly what they're going to do on the morning session, they're not tuning into the stream, right? They know this. They've been there. They've done that. For anyone who's possibly newer in the journey, for anyone who's tuning into the stream, even for those who have been long throughout their journey and just need a little bit of a reminder, manage your expectations for longs up here at the highs. Sure, it may play out over an opening range break, over the overnight high here, but just be mindful that you need to have a tight stop, because if it does turn around, there's nothing here to act as support until 12, right? The big round number. All right. So that's what I would say about the move up here, right? It's just very, very difficult to trade on the long side from a risk reward perspective. Although, right, the probabilities may say, okay, there's a high, it's bullish here. The hourly is breaking out, the 4 hours breaking out. Things look good for higher. The probabilities, and oops, we want to P. The probabilities and percent outcomes that might resolve higher may be like a 60-40 in terms of favoring longs, but the risk reward needs to be tight up here. It's got to be. There's no excuse for sloppy and crappy risk reward trades up there. There's no excuse for it. All right. That's my major warning shot across the bow for today's session. Next up is the Russell, which we'll keep very brief. Then we'll dive into the cash indexes and see what we've got from a cash index perspective and equivalent levels for your SPY Qs and IWM. I know everybody loves to see those charts. One step ahead of myself. RTY, just up towards the top of the range, right? Fake look below and fail, or not fake look below and fail, a true look below and fail, moved back to the top of the range. So this target has been fulfilled, right? This is especially a place where you would not be favoring new money longs. Remember that the trade here on the look below and fail of a range is to target the top of the range, the opposite end. So you fail down here, you target the opposite end. That trade has been fulfilled. That trade is done. Finito. Complete. Right? So would it be reasonable for some profit taking into this overhead supply, into these rejection points? Absolutely. If we go sideways and then poke above it, I personally would not want to play long there after a wall-to-wall move. More than a 100% retracement, continuing from there, very difficult to play that long with good risk reward. And that, I would say this, right, looking at a situation like this where we didn't go through it already, it dramatically increases the odds of a pullback, because we do have resistance here. We do have that 100% retracement, right? So from that perspective, I would not want to be long up here in the Russell at this area of resistance, as well from in the past. Could it break? Yes, the market can always do anything it wants, but in terms of playing responsibly in the market, pretty difficult to trade that high if you're trading long. Let's take a look at the hourly. What can we learn about the price action structure? Obviously, breaking out of this balance above this resistance here, at this resistance here. So broken, still intact. All right, let's take a look at the 15. Keep it brief. Again, psychology, everything will remain the same as what we just discussed in the NQ and the ES. Maybe slightly different because we're at the resistance in the Russell up here. Certainly would not be looking for breakouts. Instead, I would be looking for any rallies to be met with sell side pressure up around 1905. That's the overnight high. A little bit higher than that, 1915 is the gray bar up here. So if we do rally, I would look for this to be met with sell pressure up around the zone and be looking for excuses to get short. Do something like this. Overall, we don't really trade the Russell much, but it acts as a push-pull leader or appetite risk assessment for the market. If the Russell's struggling here, it's probably a sign that you don't want to be chasing the gaps in the SPY and the Qs, ES, and Qs in the upward direction. So if the Russell does push, great. It's good for a quick opening trade, right? Or however long it takes to get there. But if we start slowing down and showing signs of distribution and possibly lower highs, up around this area, probably not ideal to be chasing the gaps in the SPY, the Qs, the ES, and the NQs if the Russell is pulling back off of this top. Okay, something to be mindful of from an overall directional perspective. All right, let's get on over to this screen, and we'll go with our pre-market setup, and we'll take a look at our cash index equivalents. So in the SPY, where are we opening, right? We're opening above 408.75, above this prior high. We're breaking the resistance trend line, which is the one coming in from the all-time high. Right? Very, very interesting that we're breaking that on the CPI news, which is right here technically. You can see it very faint. We're through the upper edge of the weekly expected move. Let me be very clear about this as well. Look at the weekly expected move. This is another reason. Last week, I wasn't so concerned. You can see how compressed last week's expected move was, especially when we were just experiencing a look above and fail. I wasn't really concerned with hanging out towards the lower edge or through the lower edge of the weekly expected move. Compare that to this week's expected move and consider that we're already opening up here. Yes, you should be concerned about opening outside of the weekly expected move. Doesn't mean that we can't continue higher, but the probabilities were not looking like this was a likely outcome for the market, moving over that resistance trend line. We were instead trying to see if we could put in a lower high underneath 402.50. That's off the table, right? So everything's, I don't want to say broken here because, it's not ever technically, it is broken from a levels perspective, but in terms of something working versus not working, it could still do its job. Remember, 68% of the time. It's only 68% of the time, which is still quite a bit. 68% of the time you close inside the weekly expected move. There's nothing saying we can't move outside, but in terms of managing expectations, in terms of thinking about those probabilities and percentage, balances of continuation versus pullback, this would not suggest that you should be aggressive with new money longs this far outside of an already extended weekly expected move. Okay, so that to me is a data point stacking up in the cautious and expectation management side of the market, all right? So SPY levels to be watching. If we do pull back, just like we had that 40.90 area, it's 408.75 in your SPY. So if we pull back and hold this, that's where you're looking for the possible partial gap fill, reversal off of it, stop under the lows, retarget the opening print, and possibly higher from there, overnight high. That's how I would trade the long setup. Again, just smacking it long on the open here, very, very difficult. Not good risk reward. In terms of further than 408.75, right? It's all about 402.50 here, right? And even that is still just a partial gap fill. But it's very important because it marked the top of the balance range here, and that's where we saw the look above and fail. It's also the daily 200 SMA at this point in time, offering confluence of support. The other thing that we can point out here, and this is kind of annoying, more so than anything. Let's go to, is it a study set? Yeah. Let's bring out the anchored VWAPs, right? What else do we have as confluence of resistance where we're opening? I'll give you a hint. It's this pink line. This is the all-time high anchored VWAP. All-time high anchored VWAP is right here, all right? 410.89. We're opening a little bit above it, right? But we're opening in this area of possible resistance. Through the weekly expected move, through the trend line, through this high, around the anchored VWAP from the all-time high, I think that there are more resistant data points up here as opposed to bullish supporting data points that say we get a massive continuation follow-through move. I could be completely wrong. But you know what? I would rather be protected and wrong than not protected and right, because that reinforces bad habits. All it takes is one time and your account is blown. All right? So that's the upside. Downside, right? If we get something that does this, lower high underneath 408.75, you could look for a continuation of the gap fill on the downside with a stop above, kind of looking for a short through the equal low, something of that nature, right? So 408.75 would be the big inflection point in the SPY that's up first on deck for the market. After that, 402.50. So 408.75, 402.50, weekly expected move high. I wouldn't read into that as a support or resistant area. It's really just a zone that tells us where the market's comfortable versus uncomfortable. All right. Next up, QQQ, NASDAQ 100. What's going on with the NASDAQ 100? Back above all anchored VWAPs. Where are we in relationship to the all-time high anchored VWAP? We're not close to it, right? 314. So there's better odds from a VWAP perspective, maybe, that the QQQ sees continuation. Better odds as well that the QQQ has this as a balance area. If we break the balance, right, we typically look to double that range. So here's the range. If we double that, just based on a quick eyeball test, that's 305. That's maybe 5 points in the upward direction off of the open. Maybe a little bit more, 7 if we're opening around here. Let's just call it 298, right? So overall, maybe the NQ is a little bit better for longs if we see blatant continuation. It does not give you an excuse to not have a stop loss, but the QQQ maybe, from a daily balance break look, is a little bit more interesting on the upside. All right. Still wouldn't be my first favorite outcome. My favorite outcome would be looking for a rejection off of the resistance trend line. So this is 297.30, 297.30. You can see that's roughly where we're opening right in here. That's the resistance trend line from the all-time high. So we don't have the anchored VWAP, but we do have the resistance trend line. And if we pull back from there, just like in the ES, the equivalent levels would be 294 on the downside. So a pullback to 294, 293.75 that offers support. Possible good risk-reward trade for a move back to the opening print. That's how I would prefer to play it long if it does pull back first. If we blow through the level, looking for a lower high underneath, tighter risk-reward here for continuation and the gap close. 288 is the top of this as the first balance. This was an anomaly day, back down underneath for quite some time in here, here, and here. Okay, so it's really about the daily levels at this point in time. There's no magic secret sauce that's going on in the pre-market. It's all about knowing these daily levels where the market may pull into. Okay, next up is IWM Russell 2000 small caps. Nobody cares about the Russell. I know chat seems to hate Russell. I don't know why. In terms of where we're opening, right? 185.35 is the weekly expected move. That's here. We're opening slightly above 186.50s, still inside of this balance, right? We're still inside of this balance. So what does that mean? It means if we do move higher, as we were pointing out on the RTY futures, this is where we could see some slowdown easily and reasonably from the Russell, which would be a look to avoid chasing your SPY and Q gaps. Okay, avoid chasing those gaps up, those gap ups. There we go. Anchored VWAP from the all-time high will meet us there for resistance at the top of the range. Resistance trend line, it's all there. It's all there. All right. So 188.50. If we struggle around 188.50 on continuation, don't chase your SPY gap up. Don't chase your QQQ gap up. Rather look for slowdown, fades, or just stay neutral and sit on your hands. Let's take a look at Apple. We'll blast through the core list of companies. Let's get rid of these anchored VWAPs. They're good for the broad market. They have their place for individual equities as well, but you can only look at so many things, right? You can only look at so many things before you're like, all right, this is just annoying. Here we go. This low is obviously, I don't want to say secure, but not in play. This gap is not in play. This not pressure cooker top. This flush point is not in play. We're opening around 149.75, back in the midpoint of the original overhead supply from here. Apple, difficult chart to trade. This chart has been difficult for quite some time. Obviously, it's a big step in the bull's direction. You now want to see higher lows that stay above 146.75, the original low of that balance right here. All right, so pullbacks to 146.75 that hold. Good. Any price acceptance up here, you'd have to find a 5 or 15-minute setup to participate in the upside. The daily chart is not giving us anything obvious. Next up, Netflix. Right up towards that 328.96. So closing the gap yesterday. CPI, obviously the move that's gotten us back up towards these highs, but overall continuing to exhibit relative strength, watching for just a continuation move to close the gap overhead here. Do be mindful, and this is a blanket statement for all of our core list of companies, be mindful of the inventory correction for the gap close. All right, that's the down move first. It's the down move first before looking for continuation. If things gap and go, again, given the size of the gaps, I think it's fairly difficult to trade. Netflix might not be too bad because the gap is reasonable. It's this, as opposed to like gapping up towards 340 or something. So Netflix, bullish on higher low pullbacks over 319.50, really. Next up, Tesla. We'll speed it up here. It's 9:20. We've got to get out of here in a couple of minutes. Anyhow, so Tesla, there's your range. Tesla is not doing anything impressive. It's not gapping out of the range. It's struggling right at that 177.12. This is a really concerning look considering everything that CPI has just done for the broad market and some of the other companies we've even seen. Apple's gapping up. Netflix is gapping up. I mean, this is off of the lows, don't get me wrong, but 177 is that inflection point from the bottom of the daily balance here. That's concerning. The fact that Tesla couldn't make it through on the CPI sort of momentum, not a good look. Not a good look for Tesla. I would continue to be bearish underneath 177, only bullish on breaks with higher lows, proven, please, higher lows above 177. Next up is Google. Big gap up, right? This one's playing nicely in terms of following the broad market at least, opening around, let's call it 97 in here in the midpoint of this range. As we know, when we're opening in the midpoint of a range, not much of an edge. Don't love what I'm seeing in Google. It would have to be, as we talked about with Apple, 5 or 15-minute setup here. Be mindful of the inventory correction first. These, on a day like today, I would say that it's best to either focus on the broad market exclusively or find one stock that has a reasonable gap and focus on that. And that's it. That's it. You can't, it's very difficult to have your brain thinking about all of these large gaps spread out here, 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 like your brain's going in a million different directions, right? Try to make your job easy this morning and focus on either just the broad market. Be aware that the broad market, you should manage your expectations, or if you want to have higher probability of actually making a trade this morning, possibly find an individual company with a reasonable gap up, reasonable gap that you can trade. The broad market's going to be difficult, right? But it will be one thing to focus on. If you find an individual company, it'll be one thing to focus on, and it may not be as difficult if you find a reasonable gap, not something that's like, 100 points or 10 points, depending on the stock price, right? So anyways, Meta, sorry, we didn't talk about it, but gap up here. Where are we in relationship to some of these things? Over 118, but underneath 124. So in here, again, kind of no man's land. difficult. Pullbacks that hold 118.50 are probably the attractive look there. Continuation higher. It's all about the gap overhead. 124 should be a focus. NVIDIA, 200 SMA, clearly broken in the upward direction, well above 178.50. As we were just discussing, this would be one of those things where the gap is so large, might be difficult to trade. This probably would not be a company that I would focus on. I would rather focus on the broad market if I'm going to put myself through the pain of looking at a large gap. In terms of what the expectation is, again, pull back first. If it does go sideways and rally, difficult to pull off the long here. Next up, Microsoft, and then we're out of here. Right? Yes, I love that. JTT. Plan your trades, trade your plan. Absolutely, especially on a day like today. Where's Microsoft? I mean, just look at this. Look at the size of this gap, guys. It's huge. Right? We're opening way up here. Is this easy to trade? Not really. We're closing this old gap. We're moving into the 200 SMA. 265 should be an area of interest for shorts, possibly to roll back over. Remember that this gap technically does not count as being filled in the pre-market. It has to close in the regular trading hours session. So if 265 rejects, your target would be 260.50. All right, so look for that. That would probably be a better outcome here in Microsoft. The gap's really large. It'll be difficult to trade, but that would be my favored outlook. 265 rejection, Microsoft. Next up, last but not least, the mini beast, Amazon, breaking the pressure cooker top, breaking the bear flag in the upward direction, opening close to 95, which is here roughly, in the chop zone, right? So this was the box of chop. Remember that this doesn't really offer us an edge. It's got to clear 97 in the upwards direction, or we're kind of watching for this to be a bear flag. That's obviously off the table. So it's a patience play out there this morning, guys. I think the best things we've seen so far are possibly Tesla not gapping out of range, aggressively rejecting 177, continuing to have more of a bearish stance here in Tesla underneath that 177. And what was the other one? Microsoft, right? Just because we have a double gap in play. That makes it a little bit more interesting to trade the rejection of 265 for the move lower, because the risk is well defined on the upside. We don't have, it's not like we're opening here, overnight high is up here, right? That's not the case. There's better risk reward up here around that 265 for something that does this. Okay? So my focus in terms of companies, Microsoft, Tesla, both of them are fairly bearish. If we do see pullbacks, probably looking to favor something like Apple just because it's a darling of the market. If we pull back here and then start to show signs of support around 146.75, interested in that on upside. And that's it, right? Other than that, it's all about the broad market. How do we resolve this high? If we look at the ES, where are we opening? Has anything changed here? It'll be the last thing I give you before we sort of tune out. Nope, not a whole lot has changed. Just slow grind up here, right? Slow grind. Same thing applies. 40.90, give you the levels one more time. 40.90, 41.80, and then on the downside here, 40.40. All right? This, or this. Those are my three. Those are the three I'm focusing on for the morning. All right? That's it. Thank you guys so much for tuning in. We're out of here. 5 minutes to go until the bell. I wish every single one of you a green trading day. If you're not going to do anything on this morning session, that's A-okay. Remember, it is okay. It is okay to not trade. It's okay. No one's got your hand on the mouse forcing you to click the buttons. It's okay if you just sit the day out. It's okay if you take the morning off and come back for the afternoon session. It's okay if you take the rest of the week off. As long as you've got, if trading's your full-time job, of course you've got to show up, you've got to do the deal, but, don't feel like you've got to get involved when the conditions are hazardous. Great analogy from my good friend Michael over on the Twitter. He says things like, I can recognize that the conditions are raining, and when it's raining and I'm driving my car, I slow the car down. Doesn't mean that I think I'm going to get into an accident, but I'd like to be cautious. I'd like to, if the chance happens, if I particularly get in an accident, I'd like to be going at a lower speed. All right? Think about that when you're trading today. All right, I'm out of here, guys. Thanks a bunch. Join the Discord if you're not in there already. That's it. See you in the next one. We'll give you an update video after the close. Have a great day, everybody. See you in the next one.